You know what keeps me up at night? It's not the headlines. It's not the talking heads on CNBC. It's the phone calls I get from people in their 60s and 70s who just realize their entire retirement is sitting in paper assets while the world is fundamentally changing beneath their feet. Let me tell you about Margaret. She's 68, retired teacher from Ohio, $340,000 in her 401k, all stocks and bonds, traditional 60-40 portfolio. Her advisor told her she was properly diversified. Last month, she called me in a panic, not because the market crashed, but because she finally understood what diversification actually means in 2025. See, Margaret made a discovery that millions of retirees haven't made yet. She realized that having 15 different stock funds isn't diversification. It's concentration. Concentration in one asset class, concentration in one currency, concentration in one system. And that system is showing cracks that are getting harder to ignore. Right now, as I'm recording this, gold is trading around $2,650 per ounce. Silver's hovering near $30. And if you think those prices are high, you haven't been paying attention to what's happening behind the scenes. Goldman Sachs just reiterated their forecast. $4,500 gold by June 2026. That's not a typo. $4,500 per ounce. That's a 70% increase from current levels in less than 18 months. But here's what they're not telling you on the evening news. This isn't just about gold going up. This is about everything else going down. Your purchasing power, your savings, your retirement security, the very foundation of the financial system you've trusted for decades. Let me show you what's really happening. And I mean really happening, not the sanitized version you get from mainstream financial media. The Federal Reserve's balance sheet sits at $7.2 trillion. In the year 2000, it was $600 billion. Think about that. They've created more dollars in the last 15 years than existed in the entire history of the United States before that. And they're not done. Every crisis, every bank failure, every economic hiccup, their solution is the same. Print more money. You know what happens when you flood the system with currency? It's not complicated economics. It's basic supply and demand. More dollars chasing the same amount of goods means each dollar buys less. Your retirement account might show the same number on the statement, but that number buys less food, less gas, less healthcare, less of everything you actually need to live on. But here's where it gets interesting. While the Fed is printing, central banks around the world are buying gold at a pace we haven't seen since 1967. The World Gold Council just released their data. Central banks purchased 1,037 tons of gold in 2024. That's the second highest year on record. China alone added 225 tons to their reserves. Poland bought 90 tons. Turkey, India, Czech Republic, all loading up. Why? What do they know that your financial advisor isn't telling you? They know the dollar's dominance is ending, not tomorrow, not in a dramatic crash, but in a slow, grinding erosion that's already underway. The BRICS nations, Brazil, Russia, India, China, South Africa, they're building an alternative system. They're settling trade in their own currencies. They're creating their own payment networks. They're backing their currencies with gold. And here's the part that should terrify every retiree in America. When the dollar loses its reserve currency status, even partially, the consequences for dollar-denominated assets are catastrophic. We're talking about a repricing event that will make 2008 look like a minor correction. Let me take you back to 1971. August 15th, President Nixon closes the gold window, ends the Bretton Woods system. The dollar is no longer backed by gold. It's backed by nothing but faith and the full credit of the U.S. government. What happened next? Gold went from $35 an ounce to $850 by 1980. That's a 2,300% increase. But here's what they don't tell you. It wasn't gold going up. It was the dollar going down. Gold just maintained its purchasing power, while paper currency collapsed. A retiree in 1971 with $100,000 in cash saw their purchasing power evaporate. A retiree with $100,000 in gold saw their wealth multiply. Same starting point. Completely different outcomes. The only difference was understanding what real money is. Now, I know what you're thinking. But that was 50 years ago. Things are different now. Are they? Let's look at the data. In 1971, the national debt was $398 billion. Today, it's $36 trillion. In 1971, the average home cost $25,000. Today, it's $420,000. In 1971, a gallon of gas was 36 cents. Today, it's $350. Everything priced in dollars has gone up. Everything priced in gold has stayed relatively stable. Here's a mind-bending fact. In 1971, 1 ounce of gold bought you a nice men's suit. Today, 1 ounce of gold still buys you a nice men's suit. The gold didn't change. The dollar changed. And it's still changing faster than ever. But let's talk about what's happening right now. In real time, that's creating this urgent situation for retirees. The commercial banks are in trouble, not the kind of trouble that makes headlines. The quiet kind. The kind that shows up in their balance sheets if you know where to look. They're sitting on massive unrealized losses in their bond portfolios. When interest rates went from 0 to 5%, the value of their existing bonds collapsed. Silicon Valley Bank failed because of this. First Republic failed because of this. How many more are teetering on the edge? And what's the Fed's solution? Backstop programs, emergency lending facilities, fancy names for printing more money to bail out banks that made bad bets. Every bailout dilutes your savings. Every rescue operation is a tax on your retirement, paid through inflation. Meanwhile, the physical gold market is showing signs of stress that veteran traders haven't seen in decades. The premium on physical gold over paper gold is widening. What does that mean? It means people want the real thing, not the promise of gold. They want metal they can hold, not a contract that says they own metal. The COMEX, the major exchange where gold futures trade, they're showing some interesting numbers. The ratio of paper gold to physical gold available for delivery is estimated at over 100 to 1. That means for every ounce of actual gold in the vault, there are 100 plus claims on that ounce. What happens when people start asking for delivery? What happens when the music stops and there aren't enough chairs? We got a preview in March 2020. Remember that? Gold futures were trading at a $70 premium to spot gold. That's not supposed to happen. Futures should trade at a slight premium for storage and insurance, maybe $2 to $3 per ounce. $70 meant the paper market was breaking down. People wanted physical metal and there wasn't enough to go around. Now let's talk about silver because this is where things get really interesting for retirees looking to diversify. Silver is trading around $30 an ounce right now. The gold to silver ratio is sitting at about 88 to 1. Historically, that ratio averages around 60 to 1. In Roman times, it was 12 to 1. What this tells us is that silver is dramatically undervalued relative to gold. When that ratio reverts to the mean, and it always does, silver explodes higher. But here's the kicker. Silver isn't just a monetary metal. It's an industrial metal. It's in your phone, your computer, your solar panels, your electric vehicles. The green energy transition that governments are mandating, it's massively silver intensive. Solar panels alone are projected to consume 98 million ounces of silver annually by 2030. That's nearly 15% of total global silver supply. And unlike gold, silver gets consumed. It's used up in industrial applications. It doesn't get recycled efficiently because it's used in such small quantities per device. The above-ground stockpiles of silver are shrinking while demand is exploding. Here's a stat that should wake you up. In 1980, there were 5 billion ounces of above-ground silver available. Today, there's less than 1 billion ounces. We've consumed 80% of the world's silver stockpiles in 45 years, and demand is accelerating. The Silver Institute just released their forecast. They're projecting a supply deficit of 215 million ounces in 2025. That's the 4th consecutive year of deficits. You know what happens when you have persistent supply deficits? Prices rise, not gradually, violently. In 2011, silver went from $18 to $49 in less than 4 months. That's a 172% gain in 120 days. And that was without the industrial demand we're seeing today, without the supply constraints we're facing today, without the monetary debasement we're experiencing today. Now, I want to pause here for a second because if you're sitting on a $100,000 or more in retirement accounts, there's something you need to know. You can actually hold physical gold and silver inside your IRA. Most people don't know this. I put together a free guide that explains exactly how gold IRAs work, how to get physical metal into your retirement account without triggering taxes or penalties, and what you need to watch out for. It's in the description below. Worth checking out if this is relevant to your situation. All right, back to why this is so urgent right now. The geopolitical situation is deteriorating faster than most people realize. Russia and China are actively working to undermine dollar dominance. They're not hiding it. They're announcing it. The BRICS nations are expanding. Saudi Arabia is considering joining. If Saudi Arabia, the linchpin of the petrodollar system, joins BRICS and starts accepting yuan for oil, the implications are staggering. The petrodollar system has been the foundation of dollar dominance since 1974. Oil is priced in dollars. Countries need dollars to buy oil. This creates artificial demand for dollars, allowing the U.S. to run massive deficits without consequence. If that system breaks down, the dollars that have been accumulating overseas for 50 years come flooding back home. That's inflation on a scale we can't even imagine. And it's not just geopolitics. The technical picture in gold is setting up for a major breakout. Gold just broke through its 2024 highs. It's making new all-time highs in multiple currencies. When gold breaks out in multiple currencies simultaneously, it's not about gold going up. It's about currencies going down. All of them. The chart pattern is textbook. We had a consolidation period from 2011 to 2019. 8 years of building a base. Then we broke out in 2020, ran to 2075s, pulled back, consolidated again, and now we're breaking out to new highs. This is the beginning of a major bull market, not the end. And here's what history tells us about gold bull markets. They don't move in straight lines. They move in explosive bursts followed by consolidations. The 1970s bull market had 3 major legs. 1971-1974, gold tripled. Then it consolidated for 2 years. 1976-1980, it tripled again. We're in the early stages of what could be the second or third leg of this bull market. But let's talk about the real risk for retirees. It's not just about missing gains in gold and silver. It's about the concentration risk in traditional portfolios. The stock market is more concentrated than it's been since the dot-com bubble. The top 7 stocks, the Magnificent 7, make up over 30% of the S&P 500's market cap. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. If those 7 stocks roll over, the entire index rolls over. And your retirement account rolls over with it. Bonds aren't safe either. When inflation runs hot, bonds get destroyed. We saw this in 2022. The bond market had its worst year since 1788. That's not a typo. 1788. The aggregate bond index lost 13%. For retirees who were told bonds are the safe part of their portfolio, that was a devastating wake-up call. Real estate? It's priced in dollars. When the dollar loses purchasing power, real estate prices go up in nominal terms, but your ability to buy real estate with your savings goes down. And if you're already retired, you're not buying real estate. You're trying to preserve what you have. This is why metals are so critical for retirees right now. They're the only asset class that benefits from the exact scenario we're heading into. Currency debasement, geopolitical instability, supply constraints, industrial demand, central bank buying. Every major trend is pointing toward higher precious metals prices. Let me give you another historical example. In 2008, when the financial crisis hit, gold was trading around $800 an ounce. By 2011, it hit $1,900. That's a 137% gain, while the stock market was still recovering from its losses. Retirees who had 10-20% of their portfolio in gold not only preserved their wealth, they grew it while everyone else was panicking. But here's the crucial part. They had to own it before the crisis. Once the crisis hits, it's too late. Premiums spike. Availability disappears. Delivery times stretch to weeks or months. The time to diversify into metals is when things seem relatively calm, not when the panic starts. And right now, we're in that calm before the storm period. Gold is making new highs, but there's no panic. Silver is still relatively cheap. Physical metal is available. Premiums are reasonable. This is the window. Think about what's coming in the next 12-24 months. We have a presidential election cycle that's going to be contentious regardless of outcome. We have a debt ceiling fight that's going to make 2023 look tame. We have commercial real estate loans coming due that banks can't refinance. We have geopolitical tensions escalating in multiple regions. We have inflation that's not actually under control, just temporarily suppressed. Any one of these could be the catalyst that sends gold to $3,000, $3,500, $4,000. All of them together? We're talking about a repricing event that will define this decade. And here's what most financial advisors won't tell you. The traditional 60-40 portfolio was designed for a different era. An era of stable currencies, predictable inflation, and dollar dominance. That era is over. The rules have changed. The playbook needs to change with it. Modern portfolio theory says you should diversify across asset classes. But if all your asset classes are denominated in the same currency, and that currency is being systematically debased, you're not diversified. You're concentrated in currency risk. Gold and silver are the only assets that have no counterparty risk. You don't need a bank to honor a promise. You don't need a government to back a guarantee. You don't need a company to remain solvent. The metal is the asset. It has value because of what it is, not because of what someone promises it's worth. This is especially critical for retirees because you don't have time to recover from a major loss. If you're 45 and the market crashes, you have 20 years to rebuild. If you're 65 and the market crashes, you're selling assets at the bottom to pay for living expenses. You're locking in losses you can never recover. The sequence of returns risk is real. It's not just about average returns over time. It's about when those returns happen. If you get hit with major losses early in retirement, your portfolio never recovers, even if the market eventually does. This is why the allocation to metals needs to be significant. Not 2 to 3% as a token gesture. We're talking 15 to 25% of your portfolio. Enough to make a difference. Enough to offset losses in other asset classes. Enough to preserve your purchasing power when everything else is declining. And it's not just about preservation. It's about opportunity. When gold and silver are in a bull market, they can be the best performing assets in your portfolio. They can offset losses elsewhere and actually grow your wealth while others are struggling. Let me tell you about Robert. He's 71, retired engineer, $580,000 in retirement savings. In 2019, he moved 20% of his portfolio into physical gold and silver. His advisor thought he was crazy. His friends thought he was paranoid. By 2024, that 20% allocation had grown to 35% of his portfolio just from price appreciation. It cushioned the blow from the 2022 bond market collapse. It gave him peace of mind during the banking crisis of 2023. And now, he's positioned for whatever comes next. Robert didn't time the market perfectly. He didn't buy at the absolute bottom. He just recognized the trend and positioned himself accordingly. That's all you need to do. Recognize the trend and act on it. The trend is clear. Currencies are being debased. Debt is exploding. Geopolitical tensions are rising. Supply chains are fragile. Central banks are buying gold. Industrial demand for silver is accelerating. The paper gold market is showing stress. Physical premiums are widening. Every single indicator is pointing in the same direction. And yet, most retirees are sitting in traditional portfolios, completely exposed to currency risk, completely unprepared for what's coming. The question isn't whether you should diversify into metals. The question is how much and how quickly. Because the window is closing. Not tomorrow, not next week, but it's closing. Every day that gold makes new highs, more people wake up to what's happening. Every banking crisis, more people lose faith in the system. Every inflation report, more people realize their savings are being eroded. When the crowd finally figures it out, when the mainstream finally catches on, the prices will be multiples of where they are today. The premiums will be astronomical. The availability will be scarce. You'll be competing with millions of other people who all had the same realization at the same time. This is your moment. This is your opportunity to get ahead of the curve, to position yourself before the crowd, to protect your retirement before the crisis, not during it. Gold at $2,650 might seem expensive if you're comparing it to $100 gold from a few years ago. But compared to $4,500 gold in 18 months, it's a bargain. Silver at $30 might seem high if you remember $15 silver. But compared to $60 or $80 silver when the supply deficit really bites, it's cheap. The risk isn't in acting. The risk is in waiting. The risk is in assuming the system will continue to function as it has. The risk is in trusting that your paper assets will maintain their purchasing power when every historical precedent says they won't. You've worked your entire life to build that retirement nest egg. You've saved, invested, sacrificed. You've done everything right according to the conventional wisdom. But the conventional wisdom was written for a world that no longer exists. The world of stable currencies and predictable inflation is gone. The world of dollar dominance and unlimited money printing is ending. The world where stocks and bonds always recover is being replaced by a world where real assets matter more than paper promises. This isn't fear-mongering. This is pattern recognition. This is understanding history and applying those lessons to the present. Every fiat currency in history has eventually failed. Every government that prints money without restraint eventually faces a reckoning. Every empire that abuses its reserve currency status eventually loses it. We're not special. We're not different. We're following the same path that Rome followed, that Weimar Germany followed, that every overextended empire has followed. The only question is whether you'll be positioned to protect yourself when it happens. Margaret, the retired teacher I mentioned at the beginning, she made the decision. She moved 20% of her 401k into a gold IRA. She bought physical silver with some of her savings. She's sleeping better now, not because she thinks the world is ending, but because she knows she's prepared for whatever comes. Robert, the engineer, he's adding to his position. Every month he takes a portion of his pension and buys more silver. He's not trying to get rich. He's trying to stay rich. He's trying to preserve what he's built. These aren't radical people. They're not preppers or conspiracy theorists. They're rational individuals who looked at the data, understood the trends, and made logical decisions to protect their wealth. You can do the same. You should do the same. Because the alternative is hoping that somehow this time will be different. That somehow we can print unlimited money without consequences. That somehow the dollar will maintain its value while we create trillions more of them. Hope is not a strategy, especially not in retirement. You need a plan. You need diversification, real diversification, not just different stocks in the same currency, but different asset classes that respond differently to different scenarios. When currencies fail, gold and silver thrive. When inflation runs hot, metals preserve purchasing power. When geopolitical tensions rise, safe haven assets rally. When supply deficits emerge, prices explode. Every scenario that's unfolding right now favors precious metals, and every day you wait is a day closer to the crowd figuring it out, a day closer to higher prices, a day closer to limited availability. The time to act is now. Not because I'm trying to create urgency, but because the urgency is real. The trends are accelerating. The risks are mounting. The window is closing. Your retirement security depends on making the right decisions today. Not tomorrow, not next month. Today, because tomorrow the price might be higher. Next month the availability might be limited. Next year you might be competing with millions of others who all waited too long. Don't be the person who looks back in 2 years and says, I knew I should have bought gold at $2,650. Be the person who looks back and says, I'm glad I acted when I did. Your future self will thank you. Your family will thank you. Your retirement will thank you. The serious risk isn't in diversifying into metals. The serious risk is in not diversifying, in staying concentrated in paper assets while the world fundamentally changes, in trusting a system that's showing cracks everywhere you look. Make the decision, take action, protect what you've built, because you've earned it. You deserve to retire with security and peace of mind. And in this environment, that means having real assets that can't be printed, debased, or inflated away. The choice is yours, but the clock is ticking.